Hello, friends. Today we're taking a look at Old Dominion Freight Line, ticker symbol ODFL. In this episode, we'll be looking at the performance of the stock for the past 5 years. We'll be also talking about the analyst projections. We'll be looking at the current news, last earnings reports. Then we'll be take a look at the last 10 years of revenue, earnings, free cash flow, and book value. We'll be discussing the debt levels, the dividend history, and we'll try to find a fair value. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. If you have not subscribed yet, I encourage you to subscribe and leave a like if you like our contact, or leave a comment whether you are finding us in YouTube or in the podcast. We will love to hear from you. A couple of other things that I will be looking here is first, in the last today on January 23rd, the stock was down almost 2%. In the last month, is being down for about almost 5.5%. In the last year is up 22.4%, and in the last 5 years, an amazing 368, almost 369 percent on the last 5 years of growth. That is amazing. Analysts are projecting that in the next 12 months, the stock actually will go down to $387. Like I said, next week they're going to be projecting. This is a company that a lot of people like because of their numbers, and we'll be looking at that, their growth. Right now, their PE ratio, and this is something that we'll want to take a look, is somewhere about 35, and the forward PE is a 30, which will indicate a possible overvaluation. They do pay a dividend of $1.60, which it comes out to be 0.41% of the price of the stock right now. I don't know about you, but when I was looking at Old Dominion, I actually thought that Old Dominion was a trains company, and I plug out all the information, and as I would start looking at it, actually, Old Dominion is a truck company, and they are more in like of, if you want to think about it, as FedEx Ground. What they focus is in less-than-truckload. It's a less-than-truckload company, meaning that they ship products that are smaller than a full truckload, just like the name, and that is something that they specialize on. That they are mostly in the east, and as you can see, in the half east of the United States, but they are growing to the whole United States. Let me go really quick to page 14. In the last 10 years, we can see that the market share of Old Dominion was 3% in 2002. And in the last, 20 years, it has grown to almost 12%. This is a reason why people are willing to overpaid for Old Dominion. As you can see, the market share continues to grow and expanding in the Midwest from 5.6% to 12%, almost doubling. Northeast almost doubling. In the South from 8% to 12%. In the South Central from 6 to almost 12. 7 to 14. And then in the Pacific going from 7% to 15.4. So one of the good things about this company is that market share is doubling in the last 10 to 13 years. So that is another thing to consider whenever you are thinking about jumping into this company. Last report was on October 25th, and they beat earnings by almost 17 to 18%, and they also beat revenue by 4.3 millions. Next week, whenever they report, the market is expecting for them to report at $2.85 for the quarter on GAAP, on EPS, and then revenue to be a little bit below of what they reported last quarter. Actually, everything is a little bit lower. And revisions, but however, in the last 90 days, they have had revisions up. I think that as I was reading a lot of the information about Old Dominion, but not only Old Dominion, but also the freight industry, like I own Canadian Pacific, I own Canadian National, which they're reporting today, and I also own CSX. A lot of these companies, because a lot of analysts are thinking that the market is going to slow down, they are thinking that that these earnings are going to be slowing down too. The revenue is going to be slowing down because of people buying less stuff. So that is something to take under consideration as you are looking at those things. So let's jump to my spreadsheet, and which will discuss the last 10 years of earnings and all that information, and we'll try to find a fair value. And if you would like a copy of my spreadsheet, you can go to Buy Me a Coffee, my Buy Me a Coffee page, and you will find that in the description where you can get it. I'm trying to work a little bit more on that and bringing you more content and more things with that website. So please just pay attention to the news. I'm hoping by February I will be bringing more services to you guys. In the past 10 years, you will see that the revenue has grown 11.4%, and in the last 5 years, 10%. So I like that it's consistent. So this is one of the things I'm looking normally for, a growth of 10. 10 is a good company for me. Maybe great company. 15% is amazing. So this will be a great company when it comes to the growth in there. When it comes to earnings, this is amazing. In the last 10 years, it has grown 21%. Their earnings, and in the last 5 years, almost 18%. That is an amazing growth on earnings. The profit margins, it is pretty nice at almost 17%. That means that for every $100 of revenue that they produce, that they make, they keep almost $17 on revenue. Free cash flow, also amazing numbers, and this is why this company is so beloved by a lot of investors. In the last 10 years, it has grown almost 27%, and in the last 5 years, 16%. The free cash flow margin, it's at 13%, which is crazy. Book value, as you can see, just keeps growing. In the last 5 years, growing at 15%. That's really pretty. That's pretty good numbers. And in the last 5 years, at 11%. Return on equity is almost 24%. Great numbers. I don't normally look for 15. Return of asset is 17, almost 18%. I normally look at 5%. And return on invested capital is 22.2%. I normally look at 15. These are amazing numbers, and this is why you will see that a lot of people are going to be flocking to this stock. They started paying a dividend in 2017. In the past 5 years, it has grown almost 34%. They are generating a lot of income, a lot of money, and I'm guessing they just don't know what to do with it. So they're returning. They have enough to continue expanding, and they have plenty of money to share with the shareholders. The payout ratio right now is 15%, which is amazing. This is another thing that they have been doing. They have been paying down their debt. In the last 5 years, the debt has grown about 8%. The last 10 year at 7.6%. They could pay off their debt with less than 1 year of their free cash flow. That is just amazing. So they can pay their debt tomorrow if they want it. That's just great. When it comes to outstanding shares, also great numbers. Is being in the past 10 years, they have been buying back 1.6% in the last 5 years, an amazing 2.2%. These are great numbers. This is a great company. These are the projected earnings in the past 5 years. So 10%, 18%, free cash flow 16%, book value 11% growth in the past 5 years. Analysts are thinking that it's going to grow another 10%. So this is just great. Looking at the historical multiple valuations, this is where we're going to start having a little bit of issues with some of the numbers. I believe that the current price is very overpriced, and it is shown by the historical valuation. If we were to be looking at the historical valuation, we should be paying somewhere between, a fair value will be somewhere between $200 and $270. If we look at the latest earnings and the 12th trading number. I'm sorry for bouncing about with my words, but it's just, I will be paying more attention. I think it will be closer to $250 because of how the growth has been happening. So if you can see here, the 5-year multiple is somewhere about 25%, 25 PE, and which means we are, as I was telling you over here, we are right now at 35 or even 30 if we're looking at forward PE. It is overvalued. This company is overvalued, and it's because it's an amazing company and people are willing to pay. If we were to look at the payback time valuation, we growing at a 15%, which is a little high for free cash flow, since it's actually pretty low compared with the normal growth that they have had. But let's say this thing slow down, we're looking at somewhere around $300 on valuation. And whenever we look at discounted earnings, if we grow the earnings at 15%, which is not out of the question, as you can see over here, for the next 5 years, and then we discount it back, and multiply it by the average of 24 PE, which is what we had before, then we're looking at somewhere between 100 and it would be somewhere around $270 fair value. With earnings, owner's earnings valuation, whenever we add up all the numbers, we are looking somewhere between $160 to $192. I probably wouldn't be focusing too much on this because they do expend a lot of money on CapEx. So the fair value, I will probably be focusing somewhere around in the trailing 12 months if I put a 15% margin of safety, just because I always like to have at least that much. We're looking at about an entry point of $225. If you think that this is an amazing company and you don't want any margin of safety, then you're looking at $270 and an entrance. That is something that in the past 5 years, you will probably have to be looking back to the 2020s, at the end of the 2020s, to jump in. So right now it's overvalued. I believe that is really overvalued. It's a great company. I think it will continue to grow. So it is up to you, whatever you want to do with this. Just a reminder that I'm not a financial advisor. This is just a YouTuber sharing my opinion. And as of right now, for me, I am going to probably pass on this company. Thank you very much for listening, and I'll see you in the next video.